Hello, welcome back to Lessons into Blessings podcast. We actually have a bonus episode. So, we are bringing Jody Dents and some of his partners back on to talk about just how to be the bank and how to borrow from the bank, right? So, we're talking about private lending and so we wanted to invite these guys back, break down some more of the fundamentals in this space, just based on some feedback from you guys. So, I wanted to introduce these guys on. We have Mack Major, Jody Dents, and Rico Ferreira. And I might be jacking up your last name there. But they're with Peer Capital Partners. They lend to real estate investors for bridge, fix and flip, construction, and other rental purposes. And they're going to talk to you a little bit more about this space. So, what help me just welcome these guys on. Mac, I'll let you introduce yourself first, real quick.
Hello, my name is Mack Major. I'm one of the managing partners of Pure Capital Partners. I've been doing real estate probably now for about 30 years. I started out with basically fixing and flipping properties. Then I started, as I got more knowledge on it, I started acquiring more properties, couldn't do them all myself. Started pushing properties out to other people, which is most people know as wholesaling. So I was doing wholesaling 30 years ago. People couldn't get financing based on these properties in the area, so I started lending on those particular properties. And so I've been doing this game of real estate for the last 30 years, and it's so fun that it's not work anymore. It's just what I do is integrated in my life, and I'm here to share it with everyone so you guys can learn how to be the bank, how to participate in real estate, gain wealth for you, your family, your friends, and just build wealth. So that's what I'm here, and pleasure to be here with you this morning.
Awesome. Thanks, Mac. Hey, Jody, welcome back. You're on mute, buddy.
Oh, sorry about that. Sorry
Oh,
about
there you
that.
go. We
Hey,
got
this
you.
is Jody Dents with I'm a manager, one of the managing partners of Pure Capital Partners. I've been in this game for since 1995. I started in home building straight from college, and I started from caulking tubs and painting houses all the way to where I am now. And I learned a lot during my years. I started doing real estate as a realtor, working with investors, started working on my own houses back in the early 2000s. Became a wholesaler some houses. It's like Max said, it became a fun ride, and just became into the lending game about 2.5 years ago in the lending space because I love to provide capital to investors to for them to make money. I mean, that's the bottom game. That's the name of the game. This whole thing. So I'm just happy to be here to talk.
All right, Rico. Last.
So my name is Rico. I'm the third managing partner of Pure Capital Partners. My background, different than my other two partners, is in finance and economics. I've been a business financial advisor over two major wirehouses. One was AIG, the other one was Merrill Lynch. I was lucky enough to graduate in '02, right after September 11th, so my degrees weren't really too functional. I went back into finance in time to be able to catch the 2008 crash of real estate. I've been an appraiser. I've been in real estate wholesaling. I've done fix and flipping. I've done lending. I've done underwriting. I've done pretty much everything there is to be done on the real estate investment side, including owning a rental portfolio, except for the title side. So, any questions you guys might have pertaining to real estate or how the market economics, because the stock market, the Fed does play a big role in how the real estate market behaves, as we're seeing currently, feel free to ask those questions. I'm more than happy to address them for you guys.
Awesome. Yeah, so that's exactly what we're going to jump into is just the both sides of the house, right? So we've got kind of the active side where you guys are, providing capital to investors who are trying to do pretty much get into creative deals, and they're usually short-term deals. Can you break down just kind of the type of things that people pull on private lending for, right? And kind of segregate the difference between kind of the traditional funding, right, which is from from a traditional bank.
Okay, so the major first difference is that you really can't borrow from a traditional bank if you're doing investment real estate because there's two different types of lending altogether. One's called qualified lending, the other one's called non-qualified. What's called QM or non-QM. Qualified means that you're going to be occupying that property as an owner occupant. That's the people that qualify for FHAs. They qualify for USDAs, VAs, and conventional financing. There you're going to see the rates in the low single digits or the lowest money and the highest leverage you can get in the marketplace because you're going to be the occupant. That means that you're also a personal guarantor of that loan. That means that in the event that they foreclose on the property and like we faced basically in 2008, you're upside down on your mortgage, they can still go after you personally and say, hey, that you borrowed $400,000, the house is worth 300. We have to figure out a way for you to come up with additional 100,000 that we're missing from the lack of valuation in the property. So that's what qualified mortgages are. That's not what you can utilize if you're going to be doing a fix and flip because most of those properties just don't qualify. For example, if you had sent an inspector into one of these rehab properties, the plumbing might be out of date, the electrical paneling might be out of date, that the house just may not pass even a wind inspection. It may have termite damage. It may have a bunch of different things. So by default, that house no longer qualifies for qualified mortgages. So you have to go into the non-QM side, which is the hard money side. That means that we are able to basically finance that property, also finance the rehab of it, and we just basically tie it to an LLC. By tying it to an LLC, it becomes a non-recourse loan. That means that if you were to default on that loan, basically the only thing that we can go after is the asset. In this case, that would be the house. So that's the major difference of the two. The difference as far as the cost and the leverages for each one, as I mentioned earlier, is that conventional FHA, USDA, and VA give you the highest leverage. Conventional, I believe, goes as high as 90%. FHA, I believe, goes as high as 96.5%. And don't quote me, but it's pretty high in the 90s. So that's for you occupying the property.
Yep.
When we're looking at on the non-QM side, on the private banking side, we look at two different valuations of the property. We look at what's called the LTV, which is the as is value. What's the property worth as it sits? Not rehab, damage, termite, whatever it has. We look at that value. What's that property worth as it sits? And then we look at the ARV, which stands for the after repair value. So we want to also look at what will that property be worth once it's repaired. And also we look at how much money is it going to take to put that property in optimum conditions so that you get the highest value you can get once you try and sell it. As the bank, what we look at is we want to make sure that both the investor is getting into a good deal, because obviously if we underwrite for us, we underwrite for them. If we see that they're getting into a good deal, we'll let them know, hey, you're getting into a good deal. We can give you this much leverage. So we'll be able to give you high leverage if you're getting into a good deal. What that means is that based on the as is value, you're buying it at a price point where you have a lot of headroom.
Mm-hmm.
The assets value might be 100,000. You're buying it for 80,000. Great. You got $20,000 equity on the assets value. That's a good deal for you. When we look at the ARV, if the ARV is 200,000 and I think you 60,000 to get it up there, you're in a good deal. That means that we'll be willing to do the loan and you'll be able to do your transaction. If we don't do the loan, chances are that you're not in a good transaction, because at that point we'll tell you, hey, listen, you're buying it too expensively. Maybe go back to the seller and request a price decrease. Maybe you need to maybe wiggle your numbers on the rehab side. Maybe your guys are charging you too much. Try and get the price point somewhere around here. The numbers that they may think are correct for the after repair value may be off. They may be overvaluing the property. And once we look at it, we'll say, hey, listen, you're looking at a 250. We think it's going to be 200. So we are actually going to share with our investors and also the people that are going to be putting money with us exactly what's going on, because if we have to make sure that we're in a good deal, and by default that means that if you're not in it, we're going to let you know exactly what needs to be done for you to be in a good deal.
No, that's
So that's kind
good.
of how that works from the standpoint of the assets value, LTVs, ARVs, QM, and non-QM.
No, that's good. What would you say? And I like that you guys are helping the investors. Obviously, as any investor, like I don't want to put my money on a bad deal. And so there are a lot of people that are, from a novice standpoint, are getting into some of these loans and they don't know per se what they're doing, right? So what would you say is a good AR, what are the good numbers to say, yeah, okay, you got a decent deal, or things that investors on the active side who might be doing a fix and flip or whatever, using private funding for many different reasons, what would you say are good terms or good numbers that they should, or things they should be looking out for to make sure it's a good deal?
So when we talk about, what a good deal is. So typically what we do is we do anywhere about 65% of the after repair value. Now we look at the whole scope of the project. So when Rico talked about, so we look at the as is value first and foremost. Then we look at how much repairs it needs, which is the scope of work. So we look at your scope of work. The third is we look at the market. Where's the market at right now? And what do we think the market is actually going to get the after repair value? So what we try to do is have people anywhere. So when Rico talked about headroom before, what he really meant to say in most people's terms is equity. We want to make sure that there's enough equity in this deal that once you purchase the property and you do the rehab on this property, that there's enough profitability, which is equity that you will then be able to realize and put back into your pocket. So anywhere between 65 and 70% of the after repair value.
Yep.
So if we just broke it down in just basic numbers, if the property was worth $100,000 after it was repaired, we're only willing to give you about 65 to 70% of that, and that's for the purchase and the repair. And
Mm-hmm.
so when we talk about that, is we want to make sure, because remember, it's going to cost you money to get into a hard money deal. Just say it costs you 5 points to get into it. So if you're at 70, now you're at 75%. And remember, at the backside of it, when you go to sell that property, you have commissions that you have to pay for the realtor and closing costs. So that's about 8%. So between you add 75%, then you add another 8% onto it. So now you're in the 80% range, and you have to make a profit. And remember, every month that you have a private lender, you may have maybe 1 point per month that you're actually paying, and then you have taxes and you have insurance. So we want to make sure that there's enough spread in there. When a lot of times people come to us with a deal and they're like, "Oh, it's $100,000 spread." I'm like, "Yeah, but your rehab is $50,000. You have points to get in, you get points to get out of it. You By the time you're all said and done, you're not going to make money, and people don't understand that." So
Yeah.
what we do is we underwrite these properties. So you come to us with a deal, we help give you guidance on what to do. And a lot of times people try to finagle things to try to make things work. And we don't decline your loan because we don't want to loan to you, but we decline your loan because we want you to be successful. And we can't then give our investors back their return on their investment and then expect you to lose. We want everybody to win in this process. We try to educate. So typically a deal comes to us, by the time it comes to us, you have underwritten in your mind what you believe this deal is and the profitability is. Then we then underwrite it ourselves to make sure what the deal is, understanding that we're in all of these markets and we see what's going on. So your initial question is, where are we at? We're between 65 and 70%. Remember, the bank gives you 96, between 90 to 96.5%, which means that if you're trying to fix and flip and things go wrong, there is no room, there is no equity. You will lose. And so we're trying to make sure that our investors, whether or not they're passive investors or they're active investors, that you don't lose, because this can derail everything that you have.
Right.
If you're putting your own money, your own savings, you're borrowing money from friends and family, this is what causes issues where people don't believe and trust in one another, because you went into a bad deal, you borrowed money from people, and now you can't pay them back. Now this severs relationships, it puts you in financial binds, and this causes the mistrust that we have between what I would say are people in the industry, because nobody believes and trusted each other. So when a real good deal does come along, you've burned your bridge already. So we try to make sure that doesn't happen. And what we're trying to do with our fund is build group economics to make sure that each and every one of us gets what we need when we need it. But it's through the eyes of an underwriter that we make sure that we keep everybody on track and that we can bring it all together so you and all of us can build generational wealth for all of us.
Yeah, that's so good. And just because this is lessons into blessings, that is actually one of the lessons that always stick out in my mind, because I know a lot of investors have been burned by this. Is really know your exit strategy before you even get into the deal. You need to know how you're getting out of it. And to you, what you just said, and just summarizing it, is work your numbers and understand what all the total cost is, that holding cost of what you're going to be paying to hold that private money, the taxes, the insurance, the points, the commission. Make sure it's fully. And so it's good that you guys are doing that underwriting. Obviously, that's what underwriters do. but are really educating them as well to make sure that they're not getting burned in the deal as well. Obviously, they can take it left by not following their plan, right? But at least doing that due diligence. So that's really good.
Yeah, and to can you guys hear me? And to also add on to what Mac and what Rico was saying in regards to the market, we also look at looking at some of the communities that investors are looking at to get into as far as the value. We know what's happening right now in the market. Home values may be decreasing as well. So, we kind of hedge. Yeah, we may be wanting to give them 65, 70% loan to value, but we may go 65, maybe 60% loan to value on the property just for protection for them, because home values or property values may decrease over the year or year and a half. We just don't know that. So, but we're just having that extra hedge of protection for the investor. That's kind of one of the things that we look at, and that may be neighborhood or area specific based off the appraisal. So I just want to add that in there too as well.
Yeah, no, that's a great question, a great point, because yeah, I mean that's what people are thinking. Like, he does hard money. I mean, interest rates are going high, so does hard money even make sense, or does private funding or private lending even make sense to the active side of the investor? So it's good that you're baking that in, just because as prices start to soften out here.
And what I would say to you when you say, hey, does private money make sense? You know, it depends on the deal. No matter in good times or bad times, it all depends on the deal. And so we want to make sure that you get in a good, to deals in a good environment, and what I would call a chaotic environment, or a changing environment. So it's really a function. Private money is just like any loan that you get is should be used for a specific purpose, and to achieve, just like you said, if you know that you have a definite exit strategy, and you know what it's going to take you, and you have all of your ducks in a row. And in this business, you have to have all your ducks in a row to make sure what your exit strategy is. A lot of times people believe they know a good deal. Hey, I can get this cheap property. It doesn't matter how cheap the property is if you don't have the right contractor to put the project together. You don't understand what your end buyer is. You don't understand what you actually have, because somebody may give you a property for $1, and the property is not even, the only thing it's worth is the land itself, because the property is in so disrepair, because it may have mold, it may have insect, it may be on unstable ground. You have to know what you have before you jump into it, because it could be more of a liability than an asset to you in the long run if you don't understand that.
Yeah, no, that's good. One question or last point on the active side is back to that exit strategy, knowing how you're going to get out of it. How long do you feel that people are keeping loans from a seasoning standpoint to ensure that they can refinance out of, depending on what they want to do with it, whether they're going to sell it or they're going to hold it, refinancing out of that private loan?
On the
So,
average,
Yeah, on the average. Yeah, on the average.
go ahead, Rico.
on the average, what we try to look at is a 6 month max. Now, it depends obviously on the size of the property. If you're doing a 4,000 square foot property, we know that the rehab's going to take longer, and that because of the price point is going to be higher, you're going to have a smaller market to sell to. So if you have $1 million house, not everybody can afford $1 million, $2 million house. That means that it's going to take maybe 3, 4 months to sell the property. It might take you 9 months to do the rehab. So we look at everything as far as on the aspect, but on average, I would say that if you have a good crew and they've worked with you before, or they can get to work quickly, you can get done. I would say month and a half to 3 months would be sufficient time to get a house done, and then another month, let's say, to have the house under contract.
Yeah,
Yeah,
that's
and so one thing that I would want to add to this, in general, just for people who are active investors, and just so that passive investors can hear. One of the things that I try to keep in mind is that it's usually $1,000 per day if you're doing a project. So if you believe that a project is a $30,000 project, it should roughly take you 30 days of active participation in that project to get you out. If it's for now, so when I say active, meaning that you're doing actual construction for 30 days, for 45 days, 50 days if it's a $50,000 rehab. Remember that. And then you have the sales piece of it. So if it takes you at a $45,000 rehab, you have 45 days of active rehab. So if they don't work weekends, and you got to add more days onto it. And then you have your at least 30 to 45 days to close a loan. So I mean, so theoretically, you're looking at least 2 months. Excuse me, at least 3 months. If you got 45 and 45, at least 3 months of to hold that
To
property. So
hold
you
that,
have to
yeah,
keep it. You
absolutely.
have to keep that in mind. Most banks want seasoning if you want to refinance out of it. Sometimes anywhere between 3 to 6 months, they want at least 3 to 6 months of seasoning before they refinance. But also at the same time, people can realize that sometimes even the bank may not, depending on the area and the dollar amount, may not give you refinancing. And so there are what I would call private lending opportunities with what I'd say a fair interest rate, even if you want to go into what I call a private money side of long-term holds as well, if you can't do it immediately with a bank. So there are options for you, and the good thing about it is that we know all the options for you to get you where you need to go. You just have to trust in the process, and we'll get you there.
Absolutely. That's good.
Yeah,
That's
and then
good.
also to tag on to both Mac and Rico's, there's also an option of bridge loan. Sometimes you may pick up a good deal from a wholesaler that's a turnkey property, or a quick short sale in that area that's just heavily discounted. An investor may want to pick it up and just sell it and turnkey it. Not turnkey, but just sell it off, within a month or two of time. Well, that's an option too for getting leverage on there if they don't have all the cash to pick up the property. That's where private lending can come into play too, as well, from a very short-term transitional funding scenario to keep in mind, on top of the traditional rehab and process. So to keep that in mind too, as well.
Yeah, no, thanks. And I can say from the active side, I used private funding last year to take down something creatively, right? Because it was such a competitive market. So, I had to offer the seller just, man, I got to get this closed quick. And that's the beauty of the private funding side. But refinancing it, I had to rehab it. Rehab took about a month and a half. So it was about 2 months of holding costs, and just making sure I knew from previous experience, making sure that I could refinance it. There's no issues. We came into one snag on the appraisal side, and I had to get it reappraised just to say, hey, no, the rents are here, and this is what the property should be. So all those pieces is so important on the active side. Make sure it's together. But I'm glad that you guys are kind of educating on the back end as well. So I'm going to flip to now the private side. This is the be the bank side now, right? Like, and I don't think many investors realize the passive side. Like, if I have capital, I can lend my money, right, and get a great interest rate back on the money I have by now being the bank. So I'll let you guys. I don't know who's going to kick off, but talk about what that means, and what that means for the passive investor who says, hey, I got this capital. It's just sitting here. It's not making any interest. It's just sitting in a bank, or it's just sitting in my 401, and stocks aren't doing so great. How do I, take these funds and make better rates on it?
You guys mind if I start it off?
Go
Yeah, go
ahead,
ahead.
man.
All right, so I'll try and keep this as brief as possible. It'll be lengthy regardless. So let's talk about the commercial side, which is what we deal with. If you have a Bank of America account, Wells Fargo, JP Morgan Chase, and we're going to talk about the private side. The way that conventional loans are originated is that the bank uses your money that you have in a savings account, and they pay you for that money at this point in time. I think you're earning probably 15 basis points, or 15/100th of 1%. So you're not even making even a full percent on your money. The bank goes out, uses that money, and loans it out and does conventional loans. So they are doing the exact same thing that we're doing. They're just not paying you anything for your money. And then you also don't have the guarantees that we can offer, or the collateralization that we can offer, because if the bank, for example, goes under, or that person defaults on that loan, the only guarantee that you have is the FDIC insurance. And I mentioned this yesterday. And I mentioned a couple of times, most people haven't gone to the FDIC site and read all the small print, but I'll give you basically the important piece. The FDIC is only responsible for returning to you $100,000. Any dollars you have in the bank in a savings account above and beyond that, they're not responsible for. So if you have $250,000 in your bank account and the bank goes under, that means that the bank's only going to refund you $100,000. The other key piece is that they can take up to 20 years to return you that capital. The third component is that they don't owe you any interest on that money. That means that if they took 20 years to pay you back $100,000, that's exactly what they're paying you. They're not paying you 100,000 plus 5% interest rate that you could have earned on that money over the course of 20 years. So that's on the commercial side. Your only guarantee there is the FDIC. On the private side, we're doing the exact same thing that a bank does. We're just dealing with investors. So what's the upside for you? The upside is that you're actually collateralized by an actual asset that you can go visit, touch, and see. The same thing you're living in nowadays, your home, that's exactly your collateral. The other aspect is that, yes, you're putting the money with us. We're managing the money. We're basically the ones that have to do all the front side. We have to find the deals. We have to find the investors. We have to underwrite the deal. We have to make sure that you're in a good deal. And we have to make sure that your return as the investor that's putting money with us gets paid out. Now, what we pay for the utilization of your capital is many times over what a bank pays you. Bank pays you even in a 5-year jumbo CD, not even 1% nowadays. We're paying 7% on that money, and then we even have a possibility of being able to pay you even more depending on how our fund performs throughout the year. So let's say that we loan it out. Let's say $100,000 for ease of mathematics. We put into the property. Let's say that that property goes under. We have to foreclose on the individual. We have to sell the property. Well, the guarantee is that the asset, based on the underwriting that we did, we know that we have equity in the property. So if it was a $100,000 property, we knew that the asset value was 125. Maybe the guy put some money into it. The property maybe is now worth about 130, 140, and you owe us, let's say, $110,000. That's $30,000 of equity. So we can wholesale that property to investors. We can take over that property ourselves and rehab it and sell it. In the meantime, we have all that safety that even in a foreclosure situation or take over the asset situation, the capital is protected. So we don't have a risk per se. You don't have to wait 20 years to get your money back.
Right.
We obviously, because it would be one loan out of multitude of loans, because obviously the probability of default is, if we manage it so it's very, very low, even obviously as close to zero as possible, we make enough capital, we would still be able to pay that rate that the investor that put capital with us would have to earn. So for us, it's very simple way of us doing it as far as being able to loan the money out, pay the investor what they're worth, and also they can feel comfortable that they have an actual asset that they can go claim against, per se, in the event of something really bad happening.
It's good. I think that's the important part of what you guys mentioned earlier on the active side of the house is the underwriting that you do. The underwriting is to ensure, should anything go wrong, our investors are protected if they've kind of poured into the bank. Now, how does that? Now, is that what typical private funds do, or would you kind of segregate from your typical private fund?
So if you let me take this, so this is so as I mentioned, I've been doing private lending for several years now, and so one of the reasons that we have this fund going is because we generate between $1 million to $2 million of loans on a weekly basis, and we sometimes, because we're a smaller house, we have to recycle our funds, which means we sell notes. We sell some of the notes away to be able to keep everybody going. I mean, it's just like most people can't afford to just consistently put money out indefinitely. If we're putting out $1 million, $2 million a week, myself, Jody, and Rico don't have that much money to have $100 million go out and still be okay. So we have to sell to people. And we sell to these huge note buyers. And so when you say, well, what makes you guys different than other people? Was because we've gone through every step of this business. And so therefore, we're not just brokering deals. We're just not trying to push deals through the system just to gain a fee. So when we're using our own money, so prior to us going out for this fund, we were using our own money that, I worked in corporate America for the last 20 years. Of course, I've been out of corporate America for a minute, but I use my 401k to fund all of these deals. And I've grown my wealth even through my 401k to be able to be the bank. And so how do we differ is because we know every step of the business. We're just not a financial tool to try to actually extract money from our investors and from the borrowers and all the rest of it. We understand the process of what it takes, that if things do go wrong, all of the steps that we have, and we know how to do them personally. So therefore we can deploy our resources to get things done that most people can't. And they would then wait. I mean, I had to deal with funds every day that work remotely without any boots on the ground, and so they're stuck. And so they pay me to go out and help them get things done that they just don't know how to do. So we are so embedded in entrenched in understanding the full process and what it takes to be successful, that I've given up what I would say my own personal assets. I'm giving away my family wealth to invest into our communities because I know that I can't lose. And that no matter what, we have an exit strategy before we even started. So I feel overly comfortable using my family and my most people say don't use your own money, use other people's money. But when you come from where we come from and there's nobody to give us a helping hand or to use other people's money, you have to start with your own to prove that, listen, if I'm willing to put up my own money and lay it on the line each and every day, and I'm taking care of my money, and I'm going to take care of your money. Even I feel like I have more of a responsibility to take care of your money than my money, and I'm strict on my money. And so I just want people to know that that's what we do. We don't take this lightly. We take this as we're changing lives, we're changing communities, we're revitalizing, but we're also giving people hope for a better tomorrow. But it starts today, and we need everybody to help with this process. But you have somebody to help steward your money to get you more than what you would have gotten if you stayed stagnant. And staying stagnant, putting your money in the bank, is not going to get you wealthy. It's going to have you save, but you're letting other people use your money to benefit them. And this is a time where you could actually use your money to not only benefit you, but your communities, to build everything up so we all win and we all have generational wealth.
Yeah, and it's got to be a win-win strategy, right? Like it's got to be win-win on both sides, and I think I like how you guys are speaking to that. Is it's got to be a win for the active investor, and it's got to be a win for the passive investor as well as yourselves, right? So making sure you're doing the right due diligence. Number one, like, hey, if you've never sown your money in a private fund, you probably shouldn't be doing it, right? So and I'm saying from your standpoint, so having the experience of being the bank and and having that breadth of experience, kind of you could kind of see maybe potentially some of the pitfalls that uh, so that people you've really set yourself up to manage the risk and all that good stuff, right?
Yeah, and that's absolutely. I mean, I like what Rico said about the banks. They take your money. They give you 1% in return, maybe, but then again, they turn their money and make 20, 30% return. And what Mac is saying too as well, becoming that bank, setting up yourself for be successful and have generational wealth by having the great returns, partnering with a fund, becoming that bank. And one of the things I want to kind of talk about too is I've seen. I mean, I've basically underwritten or actually reviewed, pre-approved so many loans, and I can tell if there's an investor that we can fund or we won't touch. Now there may be some good investors, active investors who've done several deals and they're just, let's say, they're short on their credit score just because they use their credit cards to get material. Those are the kind of things that we can make exceptions on. So that's kind of the flexibility of what we would do versus a bank. Hey, your credit score is 600. We can touch you, but there's exceptions with us to make sure that the active investor is benefited from our lending side, but also the passive investor is also protected by the risk mitigations that we have in place as well. Within a fund, make sure you got to have a good accounting firm in place, a fund administrator in place, a attorney that's in place that's going to write about all our legal documentation per state. So those are the things that you have to look for when you want to look into investing passively into a fund and putting it into a safe haven, making a better return than what you would do putting it in a bank.
Yep. No, that's good. Now, if I am, and I'll just take myself an example, I'm saying, hey, yeah, sounds good. I can make a higher percentage return on my money than sitting it in the bank. What is kind of the minimum requirements from me if I'm going to do a fund of such nature? If I'm going to invest in it, is what I'm saying. If I'm going to invest in it, say, hey, I have a certain amount. Is there minimum requirements from me to do that? Can anybody do it with cash, or what are the minimum requirements for an investor to kind of jump into a fund like this and lend their money?
There's a definition that's considered an accredited investor. Now, there's for individuals and there's also for like corporations and entities per se. For the individual, is you have to have $200,000 income and a minimum net worth of a million, if I'm not mistaken, for the year. If you're married, the income has to bump up to, I believe, it's 300,000, and I want to say it's, and correct me, Mac, I may be off on this. I think the net worth has to be like 1.5 if you're married.
Yeah.
But bottom line is you have a requirement that you have to qualify for us to be able to take you onto the fund. And the reason is that the SEC, Securities and Exchange Commission, they have certain guidelines. I'm sure that most people have heard of mutual funds. If you're in a mutual fund, you can invest with whatever their minimum is. It can be $5. You can just buy a fractional share, but that means that you're an investor, and that is a registered fund that has to file with the SEC as an investment fund. What we have to file with the SEC is an exemption that we are an investment fund, but we don't qualify as a shares type of fund. So for us to be able to avoid that registration, we have to only deal with accredited investors. We are allowed to deal with a small number of non-accredited. We just can't publicly market to them. So it might be, for example, a referral. Somebody says, hey, my cousin wants to invest with you. And it could be one of the 35, which is our cap, that could invest with us, are not considered accredited. But to answer your question very quickly, is that yes, they have to be accredited investors for the most part. And the minimum investment is basically what we have at this point. I believe our minimum investment is $25,000 to be into the fund.
That's correct.
And that fluctuates, like depending on the fund, it fluctuates. But for you guys, it's 25.
Yeah, and so
Correct.
one of the biggest things about the fund is we wanted. When I say this, it's really, we wanted a fund for the people by the people. So we wanted people to say, you know what, we want to actively be involved in this fund. And so if we set the limits too high, where people were like, well, I can't really do my day-to-day business if I'm going to give you $100,000 or $200,000 or whatever it is. We want people to passively and actively be able to participate in this particular fund. So we set the dollar range where people at $25,000, I believe that people, even through group economics. So if you're an active investor in real estate, but remember, you're actively, you make that $25,000 that you're investing into us actually allows you to be able to get a return of 7%. So you're almost buying down your interest rate by investing. And this also allows money to be in this pot for you to continuously have money available for you, because you've made this available to yourself by investing basically in yourself. And so $25,000 is the minimal threshold that we have for people to invest. And we believe that that's achievable for most people in this industry. It's not too much where people are like, I don't know, but it's enough to say, listen, I have to make sure that this is something that I need to investigate to make sure, because I am putting $25,000 with these people. So.
And I like it as just from a hedge standpoint, like hedging against just where we are right now and being able to still get a decent return on your money. So that's good. Now, from a time period standpoint, because there's many different funds, right? Like I'm just keeping it 100, right? There's a million different type of funds that a passive investor could invest in, right? So for this from a private lending fund, what's your typical hold period, right? Because there's hold periods for funds for sometimes 3 years, sometimes 5 years, sometimes 10 years. What's your typical holding period from the private lending fund side?
So, so from private lending side, there's two things that are kind of mixed in there. So, the one thing is that our typical term is a 1 year term. So, if somebody's coming to us for a private loan, we typically give them 1 year to pay us back. Now, we would say, like we talked about earlier, if you're in a loan more than 6 months, you're probably eating away your equity at that point in time. So, but we don't want to limit, you to handcuff you to make you feel like you're over pressured, but no more than a year. Now we do have an extension period that we can give you, but 1 year is typically it. However, so that's for an active investor that we're giving a loan to. There is an extension period, it's 1% charge for every 3 months. However, we would like for you to be in and out fairly quickly. Now, from a passive investment side, you say, well, excuse me, if I'm only passively investing, don't you want people to stay in this fund? The answer is we do, but we want them to be able to continuously turn these properties over so they can get new properties. We want the lifeblood to keep going. We don't want to say, listen, we want these people to stay in this fund as long as possible and milk them. That's not the goal. The goal is to give them temporary funding so they can go ahead, make money, and redo this over and over and over again, because just doing it once will not provide generational wealth. So from a passive investment side, though, we ask people to stay in the fund at least 1 year before you start to ask for your money back. Okay. And the reason we say is because as we're putting your money out on the streets, remember, we're keeping them for 1 year. So we need you to be in it 1 year to let the cycle actually take its place. So it's a 1 year for the passive and a 1 year for the active. So that's typically how it goes.
Good stuff.
Matt, can I ask you to? I know that I mentioned what the yield was for the investors. Can we also talk about the profit sharing?
We can, and but the profit sharing, most definitely. But it's a function of how these loans go. But you most definitely can share it with them for sure.
Okay. So as I mentioned just a quick blurb because obviously 7% is enticing, but some people might want to be able to, hey, what else can we participate in? So as the fund does its revenues, its profitability, we also do a profit sharing with the investors that participate in the fund. So the floor that we're trying to get our clients is 7%. But what we want to participate of is also the profitability of the fund because obviously that's where you might be able to get a couple more points on your interest rate and might be able to even get above 10%. Anybody in finance, if you talk to a financial advisor, whether it's Merrill Lynch, you go to Morgan Stanley, you go to anywhere else, they teach the same philosophy. Hey, if you're making 8% annually on the market, you're doing great. But they also have you riding the waves up and down, up and down, up and down. We try to just give you consistency. Every year, we want to make sure that you're making 7% minimum. There might be some additional yields on that, but that's going to be the floor. So we don't want to ride the waves because along with the market doing its ups and downs, you also ride an emotional wave. When the market's doing great, you're at a high. When the market is crashing like it's happening right now or correcting, you're going through, man, I should have gotten out. Why did I put my money in there? I'm losing money. It's an emotional roller coaster that you go through. So we want to avoid that for the investors, not only on the side of people that want to put money with us, but also on the side of the borrowers that want to borrow money from us. I'll give you a personal example. I have a client that's done multiple deals with us. And the past month or 2 months ago, he was like, hey, I want to do more deals. I said, listen, the Fed's raising rates, that's usually a correcting situation. If I was you, I would just hold on. And he pushed a couple properties on me and I said, listen, I'm telling you again, just wait for the market to correct and then we'll go ahead and look at some deals because right now what's going to happen is you're going to pay premium because everybody's chasing real estate. The Fed's raising rates. That means that the inflation is too high. The market's going to correct because as rates go up, that means that less people want to borrow. They start increasing your qualifications to be able to get a loan. And then what happens is that people just back off from buying real estate. So as soon as the demand for real estate decreases, then so do the prices because it's a supply demand relationship when it comes to economics in everything. So I've actually advised my client. I know Mac has done it. I'm sure that Jody has done it. That when we see these things in the marketplace, we advise them so that they don't get hurt. Because what we need is a constant flow of deals to be brought to us, and we also what we want to generate is a consistent amount of growth and return for the investor. So we will advise when need be our clients to say, hey, listen, hold off on buying real estate for now. We don't want you to get bit because if you get bit, then we get bit.
No, that's good. So, what do you guys? And I'm gonna let this be the last point because we're running over. But what would you guys leave as a last thing on the passive side of the house? And I'm gonna leave obviously information. We're gonna leave information so if people want to get in contact. But generally, what should people be looking out for on the private funding side? We talked about some of the things to pay attention on the active side to make sure you're getting good returns. But if somebody wanted to say, "Hey, I want to compare multiple funds," what would be some of the things that you guys would say they should pay attention to?
So from my perspective, it's really you want to go into something that is in times of turbulent, something that is as stable as possible, and something that you won't lose your, I would say lose everything, you know. So you want something that's going to be able to keep your equity. So when we talk about stocks, I'm never. No one on our panel will ever talk about what you should or shouldn't do because that's not our business. But when we talk about stabilized, with real estate, the main reason we stay is because we have multiple options with it. We can if we need to, we can always sell real estate, we can refinance real estate, we can rent real estate. It just makes the passive investor understand that you want to go into something that's stable and that you have multiple, what I would call, exit strategies or opportunities with. And so that's what we want. Whether or not you choose our fund or you don't choose our fund, we're here to educate. We want to make sure that people make the right decisions. And maybe real estate isn't your vehicle. It's always been my vehicle. And then usually everybody on this panel, it's always been our vehicle. And it has never steered us wrong. And so therefore we stay on what's working. Why switch away from something that's working to something that we need to learn or try to figure out what's the best option? So we know that we can give you a stable return. We're underwriting all of these projects and properties. We're actually going into partnerships with people. We're providing transactional funding for people. We're making sure that no matter what happens, that not only our borrowers are successful. Now we can only do so much with the borrowers, but we try to make sure that they're successful because as they've gone into a project, we've underwritten, we hold their money. We make sure that the property is completed in each stage, and we don't release money until that's done. So that means that we hold on to the money, and we make sure that they're being properly constructed as they go through this process. So we do everything that we can, and so therefore I believe right now when the market is in topsy-turviness is that you go with something that's stable, and whatever that is for you. But I know in our market that this real estate fund is going to be one of the most stable investments that you can get and get a good solid return on your base pref return. And then if there's any upside, as Rico mentioned, you will have an opportunity to participate in that as well. So that's what I would say, but do your homework. If you have questions about our fund and what we do and how we construct it, we're just down to earth people trying to do what I would say down to earth good business to make sure that everybody wins. And we're here and we're transparent as well. There's no smoke, there's no mirrors. This is us, and we just try to communicate to you effectively and efficiently, and so you can make good decisions with your money so you can be successful. That's all we really care about.
That's awesome.
You
Thank
know,
you.
and for me, I guess I'll end with my piece. I mean, you have to go with somebody who you, of course, you like and you trust, but also with someone with a team that has experience and a track record. I could say for ourselves, between the three of us, I mean, we've generated well over 50 million dollars in real estate and origination and funding and whatnot. So we've seen it all. We've seen it from A to Z. So you want to get with somebody who has a track record and the right resources under a fund if you want to go passively, as well as actively too, as well. So that's my little spiel. I mean, you really just want to have somebody. Once you have that person with experience and they do good service for you, then you begin to really like them and trust them, and eventually you tell others about this particular company that's doing right for the people in general. So that's just my little spiel.
No, that's good. That's good. Well, thanks, guys. I appreciate. Yeah, I learned a lot within the session. Rico, your breakdown of the financial space is awesome, and just a lot of the, Mac and Jody, your tidbits of just some of the things that investors should look out for has been very insightful for me, and I pray that's the same for listeners. And so we will leave your information within the podcast. But thank you guys for joining me and taking time out of your day to just educate our listeners. And till next time.